If you like receiving monthly dividends and you like to receive them at around a 10.73% yield, then Horizon Technology Finance may be the company for you. Now, this is a BDC. We're going to run through this company and take a look at whether or not this is one you should add to your portfolio. We're going to look at the historical performance of the company. We're going to look at their income statement, top line revenue, as well as their bottom line net income growth year on year. We're going to want to have a quick health check of their company, their total cash versus their total debt. We'll also compare them to some other popular BDCs such as Main Street Capital, Gladstone Investment, and Gladstone Capital. We'll also look towards the institutions to see whether this is a company they are buying or selling. And as always, we will look at that all-important dividend safety, run through some key metrics and give our thoughts about how safe the dividend is. And we'll also touch upon their investor presentation just to give a slight brief view of the company and the performance. And as always, we will put them to the test through our stock valuation model, getting to our intrinsic value and acceptable buy price given that investor margin of safety. Now, this company is up 5.5% year to date. It is trading towards the mid to upper end of the 52-week range. And this is in fact a company that I have held before in my portfolio. It does offer a yield of around 11. And for those shareholders who have been invested in the last 10 years, you would be down around 12%. And we can see it did hit its high towards the middle of 2021 at just below $18. So is this a company that there is room for it to growth as well as locking in some very strong yields? Let's take a deep dive and find out. Now, in terms of the income statement, their top line growth as well as their bottom line, what we typically like to see is around 5 to 10% or 3 to 7 depending on the type of company. So 31 million is what they reported in December 2018. December 2022, 80 million. So they have more than doubled their top line over the last 5 years. And on top of that, with their trailing 12 months, it looks like they will be smashing again through their previous year results to have some nice growth. And as always, we will analyze that when it drops. And we can see it has had some nice growth year on year. And we will shortly look at the last 10 years percentage wise. Now, bottom line, what story does that tell us? Well, 13 million in December 2018. 21 million in 2022, so nearly double their bottom line as well, which is positive to see. On a more granular level, we do see an increase to 2019. However, it did drop before rebounding very strongly and then dropping. And we can see the trailing 12 months does look currently to be a net loss, so we will touch upon that when we do receive the December 23 results, depending on what we see there. Now, a quick health check, total cash versus total debt. 12.6 million of cash in 2018, 35 million in their latest quarterly report. So they are holding on nearly 3 times as much cash over the last 5 years. And in terms of their total debt, how has that moved numerically and directionally? Well, 127 million in 2018, 436 million in their latest report. So their total debt has also increased quite significantly, more than 3 times. So we can take a look at that dividend safety and net debt to EBITDA to fully understand the risks and the rewards of this company. Now, comparing them on a total return basis versus some very well-known BDCs, Horizon Technology are in fact up 16.5% year to date with those dividends reinvested, which in my opinion is a fairly decent return for the year to date. And we can see it is in the middle of its peers, with in fact Main being the second at 21% and Gain at 28%, both of which we have analysed on the channel. Now, increasing that data to around 5 years, as always, do look the more data you have. Horizon is up 73% over the last 5 years. Again, very positive, especially for those investors who are looking for monthly income plays. You would be up 73%. Again, we can see Gladstone is up slightly higher at 84% and Gain up 140%. And it does in fact beat Main Street Capital's 55%. But it is important to note previous performance. It does not indicate future performance, but we always like to add it as one layer of our research. Now, there's currently 5% institutional ownership with around 3.7 million worth of shares sold by these institutions over the last year. And in that same time period, we do see, in fact, more than 3 times the shares being bought at around 10.1 million. So we do see institutions are liking this company. They have bought more than they have sold, with the latest increase in Q3 at around 3.4 million versus 160,000 sold. As always though, please do not copy what the institutions do and always do your own due diligence. Now, before we take a look at the dividend safety and some metrics, let's take a quick look at the company overview. So we can see they are a leading provider of secured loans to venture capital backed and private equity backed growth stage companies, which is essentially what a BDC, a business development company, is. And they generate their attractive risk adjusted returns through directly originating these secure loans and additional capital appreciations through warrants. Now, we'll touch upon this, which is what they focus shortly. We can see they have a very high 16.1% TTM trailing 12 months average debt portfolio yield, which is why we can see they are able to offer those high yields to investors. And we see they had a $1.32 per annual share distribution, and they also do pay some special distributions from time to time. Now, one thing that we haven't actually analyzed on the channel frequently when we do look, in fact ever, when we do look at these companies, is management, and it is something that I do believe to be important. When you analyze companies, one of the things you should look for is for management in place who have been there for a significant amount of time if they are performing very well. Sometimes you look at companies and you do see that management have been in place for only a year or two, which does create some uncertainty. So very quickly, we can see on the board we have the CEO and chairman, who was a co-founder, alongside the president and director, also a co-founder. We have the COO, the Chief Operating Officer, who was with Horizon for 2004, so coming up to 20 years. We have the essential CCO, Chief Compliance Officer, who was a founding member. And we have the CFO, all these acronyms, since 2006. So again, long-standing with the newest member since 2019, the Chief Credit Officer. So when we do have that information, it is quite useful just to take a look at management to see how long they have been there in their credentials. Now, in terms of just a few of the numbers, 17.1% annualized debt portfolio size. The yield, in fact, the size at 729 million. As we see the yield, this was essentially from a few months ago, so we see it around 11.1%. It has come down slightly. And their total return over the last 5 years at 71%, which is what we just saw right now. Very, very strong. So it is positive in my opinion. And when we take a look at the essential parts of where they have been in, we do see their investments have been in the technological industry by quite some way. And then we have the life sciences and healthcare as well, which is why essentially they are called Horizon Technology and Finance. So again, lots of positives to note. Now, the important thing here is that dividend safety, as you are essentially investing in this company for those monthly high yield dividends. So we do see it coming to 40 unsafe, so we can touch upon that. Market cap 410 million, so it is a small cap company. So when we take a look at some recessionary data, well, they didn't pay a dividend in the last recession, so we can't analyze that. However, they did have plus 19% sales, which was well above the average growth. If you remember, it was negative for S&P 500 companies. Now, dividend growth, they haven't actually paid any increases for quite some time, and we can see there was a very small cut when we look at the last 10 years on average. When we take a look at the growth, we can see it did peak in around 2011, and then we see a cut, and then it remained relatively flat before a smaller cut and relatively flat. So something just to be aware of as investors or potential investors. And they do also do special payouts, which typically tend to be in December. Now, when we take a look at dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. So at 10.73 versus 10, we have a sign of reasonable valuation / undervaluation. And we can see the forward P at 7.5, significantly below the 5-year average of 9.5. Now, in terms of the PE comparison to the sector, the financial industry is quite high at 10.3 versus Horizon 7.5. And as I mentioned, it is trading towards the mid to higher end of the 52-week range. But bear in mind, 52-week low is not a signal for undervaluation. 52-week high, as you know, not a signal for overvaluation. Now, typically, we like to look at the free cash flow. For BDCs, it is a lot more volatile due to different reasons, so we will focus on the earnings. What we tend to see is below 95%, as they do pay the majority of their earnings through as dividends. So what we can see over the large period, they have had some above 100%, which, as you know, it's not positive. What this essentially means, if we look at, say, 2017, they paid out a lot more, in fact, 112% of their earnings as dividends. So they're paying out more in dividends than they're essentially generating as a business. Now, the last few years, it has been under control at around the mid-80s, with 2023 coming down to around 80% as well. So there's more positive, but something to keep an eye on. Earnings per share, well, it has moved fairly inconsistently, however, from 138 to 146. We do see some peaks and troughs. So again, just understand the type of company you are investing in. Now, when we take a look at sales growth, we can see as well, very mixed. But again, some periods we do see some very strong double-digit growth. And when we translate that numerically, what we see is 33 million in 2013, more than double in 2022 at 79.2 million. Now, it is typical with BDCs, as we've mentioned earlier, due to their high payout ratios, and we've said this on other episodes as well. BDCs, they have to generally borrow money to issue shares to grow their business. So we can see your position as a shareholder does get diluted over time, and you can see the rough rate from 9.6 million shares in 2013 to 25 million in 2022. Now, ROIC, again, for BDCs, around 8% or more. So they have been fairly consistent year on year. It is positive to see. We did take a quick look at management. They have been there quite long standing. In fact, a lot of them are co-founders or founders. So it is positive to see. And we see the trailing 12 months at 11%. So that is a plus in my opinion. Now, both margins aren't really applicable for BDCs. Likewise, neither is the net debt to EBITDA. The reason for this, EBITDA is not meaningful for them due to the fact that interest is a core component of their revenue expenses, which is what we'd expect given they are lending a lot of money. So that is the general gist of the analysis. Now, when we take a look at the stock valuation model, we want to get to the intrinsic value. And as always, if you enjoy the content, value is being provided, do smash that like button, hit the subscribe bell so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio, then do click on that pinned comment below to also get your acceptable buy price. Now, jumping straight in, Graham's valuation isn't really useful or relevant for BDCs. But for those that are new, we typically put the stock ticker symbol, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remembering the higher the yield goes, the lower the intrinsic value. So moving on to the first model that we're using, we're looking at the multiples valuation model, companies in a similar sector and size that we ran through. We had the Gladstone Capital, Gladstone Investment, Hercules Capital, and Main Street Capital with their stock price, earnings per share, and their PE, with the average coming to around 7.9. Multiplying that by the PE of Horizon, we get a stock price of around $7. Now, when we take a look at the current price, that is well below the current trading price and in fact below the 52-week low, showing signs based on that one model of overvaluation. But remember, we don't look at any model in isolation. Now we move on to the second model, which is the dividend discount model with the yearly dividends. Now we can see the average growth for the large part has been fairly flat, and that gives us a 1.9% average 5-year yield. Now, what I would say is I have gone for 1% forward looking. You could say that's too pessimistic or even too optimistic. So if you grab a copy of the model, you can play around with the figures based on your own investment thesis. So this gives a DDM price of $19. That is well above the 52-week high and above the current trading price, showing signs of undervaluation currently. Now, given this is a BDC, these cash flows are not relevant, this model, the DCF model, as essentially the company is very volatile due to the way they operate as a BDC. So we are removing this from our final calculation. And as always, the intrinsic value is therefore just the average of the two models that we have run through, coming in around $12.92. Now, don't forget, if you do enjoy the content, value is being provided. Do hit that like button, do subscribe and hit the bell so you are continually notified of these videos as they drop. Now, margin of safety, what we would typically start off with would be 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we can see really it's not a buy even at 10%. It probably, if we do move that to 5%, you do see right now, if you were to lock in, you would be getting a rough 5% margin of safety. Those looking around 20%, you would be waiting around 10.33. And if we take a look, that is right there at that 52-week low, which I think would be reasonable if you did want to start. But always remember to do your own research and own due diligence. Now, what do Wall Street say? Well, they say that the price would go around $12.62, so very, very minimal room from the current trading price. So when we do take a look, you are essentially getting a rough 5% margin of safety and roughly a very minimal upside in relation to our intrinsic value and forecast from Wall Street. So what this is saying is that essentially it is trading at a fair value. You are locking in a 10.73% yield. But bear in mind a few things, one of them being that Wall Street aren't forecasting much upside. We don't believe the intrinsic value to be much higher than the current trading price, and the dividend growth has been fairly flat for a long time. So I would be interested to hear your thoughts whether or not the pros outweigh the cons, whether or not it is worth still getting a yield, a monthly yield of 10 to 11%, or for the long term, this isn't a great company to invest in. As always, drop your thoughts and comments below whether this is a buy, sell, or even if you hold this or don't hold this. And as always, if you enjoy the content, do hit the like button, do subscribe and hit the bell so you are continually notified of videos as they drop. And if you do want to grab a copy of the valuation model to get your own intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment. As always, have a great day, catch you on the next episode, and take care.